So, good day, everyone, from everywhere you might be listening to me. Welcome to this first session of strategic financial management. This is course one, and we'll be kickstarting with capital budgeting. Under our course outline, if you have been able to privilege, if you are privileged to have viewed it, you'll see that what we have first is capital budgeting. Capital budgeting is the same thing as project evaluation or investment appraiser. And then this capital budgeting or investment appraisal or project evaluation is also always very important. Is the essence of why an entity is in business. Is more or less a core, the reasons why an entity is in business. So, and the essence is if you're unable to appropriate the capital that you have adequately and appropriately, and then you should know that you will not be in business. So the beginning of failure of any business is not knowing how or where to invest the capital that is available to the business, not knowing how or where to invest the available capital that is in the business. So we'll be looking at this capital budgeting as a topic, as a session to understand this very, very importantly as a financial manager, as a financial analyst, as a strategic financial manager. It's important that you must be able to know how to evaluate projects appropriately, evaluate investment appropriately, and that's why we are looking at this very, very important topic first. So, by definition, like I've said, capital budgeting, investment appraisal, or project evaluation is the process of planning and channeling available resources to a business that is worth it in order to maximize shareholders' wealth. The essence of why you have capital in the business is for you to be able to use it well and so such that you can be able to maximize and the shareholders' wealth. And that is that for that. It's as simple as that. Being able to channel the capital that is available appropriately. That is all that is about capital budgeting or appraisal of investment or project evaluations. And so it's important for you to know the steps to also follow. And that is why I like the following as the steps to proper investment appraisal. Number one, you must be able to identify available opportunity. You have the funds with you. You need to be able to first of all identify the available opportunities where in an exit you are to channel your resources to put those resources adequately. So you look out for all of the opportunities. That's the one you look into first, and then number two, you need to screen those opportunities. You need to screen those opportunities to align with current and future objective of the organization. Not all the opportunities or the available, channels where you can put those money align with the current objective or future objective or the company as a date. So it's important that you must be able, very, very important that you must be able to identify which in exile with which of the opportunity in exile we align with the core objective of the business. And the third one is after you have screened the opportunities that are available to the ones that you want, you evaluate the choosing opportunity. You need to do what we call evaluation, capital budgeting. You need to evaluate them. All of these opportunities put together, you need to evaluate. If it's one, you evaluate it. If there are more than one, you evaluate all of them together. And if there are more than one, the essence of you evaluating is to know which one out of the many to choose. And if it's one, you need to evaluate to be sure that it is worth putting in the funds. And so, very quickly, what are the methods? We are methods of evaluating some of these investment or projects. Well, we were able to group them into two. We have the traditional method, and then we have the discounting method. The traditional method and then the discounting or the conventional method. The traditional method consider two major methods. The first one is known as the payback period method. The payback period method, this one measures the year or the time in period it will take for an investment to actually be returned. You understand? So this one consider, okay, if I put in my 1 naira today, when exactly will that 1 naira return back to being, even with profit? You understand? So that's that for payback period. And then accounting rate of return is the second method under the traditional method. Accounting rate of return, also known as a return on investment. This one is looking at if I put in my money now, what amount or what percentage of it will return to me as profit, the returns on the investment. You look at risk that is involved, and then how exactly have you been able to minimize the risk as well, me having my returns. When we look forward further, when we go further, you will understand it better. Then we have the discounting method or the conventional method. Under this discounting or the conventional method, you have what we call the NPV, the net present value method, the IRR, that is internal rate of return method. You have the MIR, modified internal rate of return method, and then you have the adjusted present value, that is APV method, and there are so many others. But for these levels that we have now, these four are very enormous and okay for us to understand in the discounting under the discounting method of a project evaluation. So please just get yourself ready. We'll look at every of these six methods. We'll look at them with examples in this session of lecture. Please just stay tuned and stay glued, and I believe that you will have better understanding. And so the next steps that you take after you do your project evaluation is to settle with the one that has the best cash flow and benefit, and that is ideal thing to do. That's where you put in your fund, and then that is the process of implementation. You put the capital into those investment, and then the last steps is that you need to conduct what we call post audit review. Post audit review, some people call it post completion audit. Post completion audit, it is important that you must do it, and the essence mainly is to know whether you are right with your decision or you are not right. What do you need to change? How do you need to remodel it? Should you recover the investment? These are the core reasons why you need to do what we call the post auditor review, and that is that for that. So very quickly, so without wasting our time, let's go to those method of evaluation. And so we kickstart with the traditional, like I've said. We have two major methods now: the traditional, the payback period (PBP), and then we have the counter rate of return ARR. So we have the payback period. Under the payback period, like I said, this method tends to evaluate the time and period to recover your initial investment. Is important for you to know exactly the time for you, for when exactly there will be a return on what you have invested. When will the money come back? When will the investment return back to you? And so for the decision rule, the shorter the period, the better for the entity. And the formula is initial outlay divided by annual cash flow. The initial outlay, that is the initial investment in the business, and then the annual cash flow. What is the annual cash flow? And this formula will always be applicable in any given circumstance. Please know it very well. It's very simple to know. Initial outlay, initial investment. I have 1,000 I want to invest, and then you now project that, okay, if I put this 1,000 the first year, I should be able to get 500. The second year, 500. So you look at it that way. So for you to get your payback period now, you divide 1,000 divided by 500, it will give you 2. Meaning that in 2 years' time, your 1,000 will come back to you. Simple as ABC. Thank you very much. So let's look at illustration under that. Illustration 1, you were just employed as a financial manager of Tinubu PSC. In your first finance meeting, sorry please, in your first finance team meeting, it was agreed that the following projects will be considered for investment. We have project ABC. The initial investment to pull in will be 20M, 25M, and 15M. Currently, the team projected 15, 24, and 25M as expected return for the next 5 years on each of the investment respectively, on each of the project rather of the project respectively. Please, sorry for that. Respectively, determine any of the project that is worth considering using the payback period method. Solution: I've told you the formula is initial outlay all over annual cash flow of the project. So we have project ABC. We have initial investment 20M, 25M, 15M. Annual cash flow, they say, is 15M, 24M, and 25M. So The answers will be when would the cash flow return the annual investment? For project A, we have 1 year, 3 months, 3 days. When you divide 20 by 15, this is what we will get. So we have 1 year, 3 months, 3 days. For project B, we have 1 year, 0 months, 4 days. 1 year and 4 days. For project C, it is in 6 months. So by what I have said, I said the shorter the period, the better. From this project now, the one that is faster is project C. Look at it. The amount to even invest is 15, and the annual cash flow that's the inflow that you expected is even higher than all the other one. So you should know that in 6 months' time, your investment will come in. Huh? So if you are asked to analyze, it's easier. You just look at project C is okay to be considered, and that is that for that. So let's look at another one. A project requires an outlay of 50K in year one and 66K additional at the beginning of year two. Huh. Understand this before I proceed. Anytime you see an initial outlay or initial investment, all of those first investment, they are always at year zero. They are always at year zero. They are always at year zero. Look at this now. Then I say another 66K at the beginning of year two. At the beginning of year two, meaning that the closing of year one is what begins year two. So this additional is actually going to be spent in year one. This additional is actually going to be spent in year one. Then I said they have labor and production cost will be 12.5K per year. That's from year one till the end of the project. If the project is ready to last for 10 years, meaning that they are going to have labor and production costs to be for 10 years. Then I say if the project is going to last for 10 years with revenue of 44K expected per annum from the beginning of year four, meaning if they say beginning of year four, meaning that they have actually hand this 44,000 in year three also. In year three, please always look at the questions details in details. There are small things to confuse you, but they will not confuse you because you are listening to me now. There's a revenue of 44K expected per annum from the beginning of year four, meaning they hand it in year three. They say determine the payback period of this investment. Solution very simple. I've told you is always your initial outlay, initial investment divided by your annual return or annual what is it called? Annual revenue or annual income or annual cash inflow as it were. So let's really look at this. First, to say we have outlay at year zero, they say it's 50. Then now say we have additional in year one, they say it's 66. And then we have labor and production costs year one and two to be 12.5 plus 12.5. That's why we got this 25. 12.5 plus 12.5 is equals to 25. So the total is 141. This is your outflow from year 1 to 2. So, and then I told us that the revenue, which is 44, is also expected per annum from beginning of year 4. There is no way you can earn revenue if you have not gone through a production process or through a trading process, through a turnover process. So the 44 is not going to happen in the beginning of year four. It will have happened in year three. Meaning that year one and year two, there was no turnover, there was no revenue. They were just investing year one, investing year two, investing year zero, they invested year one, they invested year two, they also invested. You understand now? So it's in year three that they started to make profit. They started to make profit, or they made their income in year three. So all the cash outflow year zero to year two, we combine them together, and that's where we have a 141 million. And then we now we call the net cash flow in year three. The net cash flow means that cash inflow minus cash outflow will always give you your net cash flow. Cash inflow minus outflow will give you your net cash your net cash flow. That's what we did for year three. So meaning that if you're 44 minus 12.5, I rounded off the figure to be 32. I think that's what I did. That's why I got this 32. 44 minus 12.5 it should give us 31.5, but because I don't want to have points, I have rounded it out to 32. So meaning that the first 2 years first, which is certain, the investment first for first 2 years, abi. So we need to do that of the third year to know what exactly the figure the other years will be. Since we said it's our initial outlay divided by the cash flow. And we now have a total for year one as outflow. The outflow for year one, year zero, year one and two to be 141. And then the net cash flow, that's the annual cash, that's why I say annual cash flow for that year three. That's why we got this 32. So meaning what we are going to get here will be 2 years, that's the 1 year first and second year, the 2 years plus the annual, the outflow for year three, the payback period for year three. So whatever year three is going to give us will now be the total put together. So we have 2 years. When you divide 141 by 32, you're going to have 4 years and 41 days. So if you add 4 years plus the initial 2 years that there were no revenue, there were no income, you're going to have 6 years and 41 days in total for this investment to return. And that is that for that. Very simple. And then alternatively, you can do it this way. Put it this way: item, year, cash flow, then cumulative cash flow. You understand? So outlay, they said the first year, the first year, which is year zero, the initial outlay is 50. Now said in year one, like I told you, they said at the beginning of year two, meaning in year one, there's an additional of 66. So if you add 66 to 50, it will give you 116 cumulative. That's why we say cumulative. Then in year one and two, they say there is labor and production cost. So labor and production cost for year one and year two is 12.5 plus 12.5, and that's 25 million. So if you totally, you have what we call 141 141 M, which is the same thing that we got under the first method that we use, under the first this thing that we use, alternative that we use. So in year three, we have what we call the net cash flow. Like I told you, your initial loan minus what is it called? The cash inflow minus the cash outflow will give you your net flow. So year three net flow, if you remove it from 141, you have 109. Year four, you have 77. Year five, you have 32. Year six, you have 13. Meaning that 32 can no longer go in this 13. So if 32 can no longer go in this 13, that means your payback period will start from year six. So you have your year six now. Now, for you to get what will be the days, it will now be this 13 as the remaining divided by 32 that you have to remove. And that's why we have 6 plus 13 divided by 32. So now it's 6 years and 41 days. And 41 days. Please, it's as simple as this. There's nothing too difficult in it. For you to even know it very well, set a question for yourself, by yourself, and do it, and you will see the magic that is in this thing. Huh? Please note, however, before I conclude on this paper period, note that payback period do not consider accounting profit. They don't look at accounting profit. Rather, they look at cash inflows and outflows. Cash inflows and outflow. That's what they look at. Also, they don't consider other cash flow after the payback period, and that's the disadvantage with this method. That's the disadvantage in using this method. The advantage is that it's easier to use, it's easier to understand, it's easier to prepare. However, the disadvantage is that they don't consider all the cash flows, and then also they don't look at the accounting profit, and then they don't look at what we call the time value of money. They don't look at the time value of money. That's why the other set of method is being used. You understand that discounting method now, they look at the future cash flow and discounting into present value. So let's quickly move to the next one, which is accounting rate of return. And our accounting rate of return, very simple. Also, they consider accounting not profit, they do not consider cash flow. So if we can start with that advantage and disadvantage too under accounting rate of return. The accounting rate of return, they don't consider cash flow. Rather, they look at accounting profit. And accounting profit is generated with a lot of questions. A lot of questions. For instance, there are so many non-cash items that most of the time they are being used to arrive at accounting profit. For instance, depreciation, they are non-cash. Provisions, they are non-cash. Impairment, they are non-cash. All of these ones, they are most of the time considered before we arrive at accounting profit. So accounting profit is also not good for project evaluation because they won't give you the real picture of event as they should be. You understand? Also, their disadvantage is that they do not consider the time value of money. But the advantage is that it shows you your return on investment, even with all of the unnecessary adjustments that have been made to the profit. It still show you the rate of return. Number two is easier to understand by users, by decision makers. It's easier to understand, and then it's easier to prepare for accountant. It's not all that complex. That is that for that. So let's look at this formula for accounting rate of return. It is annual average accounting profit. Annual average accounting profit. Annual average accounting profit divided by average investment. Divided by average investment. Your annual average accounting profit, when they tell you that you make profit of 50,000, and they said that the project will last for 5 years. What you do is, for you to get your annual average accounting profit, is to divide the total profit 50,000 divided by, let's say, since it says 5 years, divide by 5. It will give you your annual. What you are evaluating is annual, so it will give you your annual. Then the second one is average investment. Your average investment is your initial outlay divided by 2. Initial investment divided by 2. Initial investment divided by 2. If you have residual value, you remove it from it. You understand? Please take note. Very, very important. So let's look at the illustration under this also, and the solution. Then we move forward. Consider your organization to or purchase an asset for use with 120 million and has a residual value of 20 million after 5 years, with cash inflow of 40,000 each from year 1 to 3, and thereafter to 50 year to be 20k. Let me take this question again. Consider that your organization is to purchase an asset for 120 million, 120 million with a residual value of 20 million after 5 years. After 5 years, okay. The cash inflow of 40k each is expected from year 1 to 3, and thereafter to 5th year to be 20k, meaning that the 4th and the 5th year will be 20k each. They say determine the worthwhile of the investment using accounting rates using accounting rate of return. Accounting rates accounting rate of return. Hmm? So it's as simple as that. What's the solution? Let's quickly run through it. The first thing first is we need to determine the accounting profit that is made. We must determine, and it's as simple, very, very simple. We were told that the total cash inflow for the first 3 years 40,000, and that will be 120,000. And then now told us that then for the fourth and the fifth year it will be, for the fourth and the fifth year it will be 20,000 each, and that's 40,000. So when you add 40 plus 120, to give you a total income of 160,000. But then we're also told from this question that the asset was purchased for 120,000, and then it has a residual value of 20 million after 5 years. It will imply that the cost minus residual value will give you the accumulated depreciation. To give you what we call the accumulated depreciation. And so cost minus residual value is equal to depreciation. That's 100, and that's 100. So when you remove, and depreciation is an expense. Depreciation is an expense under accounting. So when you remove your income, revenue minus expense, it will give you your profit for the year. So 160 minus your 100 will give you 60 for the year. So it's as simple as that. Sometimes they can come with some of these small, small questions. If you don't know it, you don't know it. So understand this that it is as simple as this. It's not something that is difficult to do. It's something that is within your power to deal with any day, any time. So that is that for that. Um, then answer the number of year of the project is 5, and then for you to get your annual average annual accounting profit, as it were, you divide the total profit that has been made by number of years, and that will be equal to 12,000 per year. 12,000 naira per year. And so, secondly, we determine the average investment, initial investment divided by 2, and that is initial investment that we were told is 120 million. So, if we divide 120 million by 2, 120, like I told you, we remove the residual value. 120 minus 20 we give you 100 divided by 2, we give you 50. And so if you put 12 divided by 50, you have 24% to be our accounting rate of return. So please, let's end this class on this note. There's going to be lecture 2. I want to make it as simple and as brief as possible. And that's why you have all of these. So that's why we have all of these put together, as it were. I will send in the next slide very shortly, and then you have a good time running. So please run through it again, and then ask me questions privately. And the next one that we'll look at will be on the discounting methods. Thank you for your time once again.